Good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, certified financial planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation, I'd love to hear from you. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. That's 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interests ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m. That's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, DSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance we are here to discuss tonight. 627-7979. All right. Last show was a pre-record. I was not here live last show. Down in Aruba for vacation, and the first time I've ever been to Aruba, and it was pretty much as advertised. Weather was fantastic. Highs of 81. Highs of 88, lows of 81, except for the day we had a heat wave, and it was high of 89 with a low of 82. Turquoise blue water, white fluffy sand that does not stick to your skin, and endless pina coladas. So, and friendly people, the friendliest people around, the Arubians. If there's one drawback to Aruba, I think it was only due to the fact that I heard more New Jersey accents than I heard Arubian accents in Aruba. So in the resort area, it's like America South. Not South America, but America South. But a lot of fun, Aruba. I'm back now and ready to go. All right, tonight we're going to talk about a continuation of 2 shows ago where I talked about the role of insurance in personal financial planning. But before I get into that, as promised, we have a caller on the line. So we have John in Suffolk. Good evening, John. You're on Dollars and Common Sense. Do we have John in Suffolk?
Hello? Yes.
Yes, John, you are on Dollars and Common Sense. Hello.
Yes, my question is I've done real well. I'm 55 years old. I have retired. I have a large 401k. I met the time and service requirement where I had enough service and old enough to where I could leave my job. I don't have to pay the 10% penalty on withdrawal. But my question is I'm being pushed to move things to I have an IRA, it's an IRA now, of course, but I'm being moved to push things to a tax-free, to move things over, pay taxes on it, and then later when I draw out, move everything over to tax-free. Is that worth it, or is it just, what are your thoughts on that?
John, I'm not sure I'm following you there. Take me through it again. This money is... has been moved from your company retirement plan into an IRA?
Yes. My 401k has been moved into an IRA.
Okay.
Now I'm being kind of pushed, or the company I'm with wants me to move everything over, start moving things to a Roth IRA. Is it worth it to do that, or is it worth it to do that?
Okay, all right, that makes more sense. So, company-sponsored retirement plan probably did a direct rollover into a traditional IRA, which still stays in its tax-protected wrapper. So, a non-taxable event when you did that rollover. However, when you go to withdraw the money from the traditional IRA, then all the money that comes out as ordinary income, which is the highest tax rates that we're faced with. A technique or a strategy. Go ahead.
And I have a fairly large 401k or IRA. I just crossed into 8-figure territory.
Okay.
And, you know, I just want to make sure I'm doing the right thing to move it, pay the taxes on it, and then go the other way with it, with the Roth.
Yeah. Okay. So a strategy that one can employ is to transfer some of the money or all of the money that's in the traditional IRA and do a conversion, it's called, into a Roth IRA. Once it's in the Roth IRA, then the future growth of the investments and all the withdrawals is tax-free when it comes out of the Roth IRA. However, when you convert the traditional IRA into a Roth IRA, that itself is a taxable event. So you can't avoid taxes. It just is a question of when are you going to pay the taxes? Are you going to pay the taxes on the withdrawal from the IRA in retirement when you're going to use it for spending? Or do you want to sort of advance pay those taxes, move it to a Roth, and then enjoy tax-free withdrawals for the rest of your life? Okay, so that's kind of the framework that we're looking at here. Now, should you do it? Okay, that's the $1 million question, or in your case, maybe the $10 million question. I will say this. The calculation to determine whether it is beneficial to convert a traditional IRA to a Roth IRA is highly complex and highly personalized. While anyone can do the transaction, just because you can doesn't necessarily mean you should, that it will be in your long-term financial best interest. Every dollar that you convert from that traditional IRA will, again, that comes out as ordinary income. So there are certain conditions that we find need to be in place in order for the conversion to make sense. And generally speaking, what we see is that the owner of the traditional IRA is relatively young, in their 50s or early 60s. That person has going through a period with relatively low income from outside sources or from their job. In other words, maybe they have retired fully and are not earning any income, so that they're in a lower tax bracket to start out with. And they or their spouse has a relatively long time horizon or life expectancy. And those and some other conditions, if those and some other conditions are in play, then when we do the math and crunch the numbers, it can make good sense to make some Roth conversions. On the numbers you're talking about, the size that you have, I would find it highly improbable that all of it would make sense to convert, but you can make the case that maybe some of it would be appropriate to convert and would be in your long-run financial best interest. So was that any of that helpful?
Yes, it was very helpful.
Okay. Now, I don't know if it leads you to a specific decision, because obviously we wouldn't want to know the actual account balances, more about your other financial situation, so forth. But I can say if if it's being recommended, you said pushed. You said the company with is pushing you. First of all, no financial services company should be pushing you to do anything. That's not advising, that's selling. So you should be working with an advisor who presents options to you that advisor believes is appropriate based on your unique financial circumstances and allow you to make your own decision on which option is best for you.
Okay. Well, I appreciate your time,
Mm-hmm.
and I greatly appreciate your time. But yeah, I kind of feel pushed to move things, and I mean honestly, at where I'm at, I've got more than enough to last me the rest of my life.
Mm-hmm. Mm-hmm. Yeah, and there can be good estate planning reasons for wanting to make a conversion from traditional to Roth, because the Roth IRA does not require any minimum distributions throughout the rest of your life. Once you reach age 73, John, you are going to be forced to take required minimum distributions out of your traditional IRA, whether you need the money or not. And that's a form of, forcing money out of the IRA and having it taxed at ordinary income tax rates. So sometimes part of the math calculation is, well, if we convert some of that today over the next, say, 4, 5, 6 years, then even if we don't convert all of it, then that just means your required minimum distributions later in life are that much later because you sort of spread it out in your early years, if that makes sense.
Okay. Well, thank you very much. I appreciate your time.
Okay, John. Thanks for the call. We appreciate it. 627-7979. All right, before I jump into today's topic of the role of insurance in personal financial planning, let's pause right here for a short break. We'll be right back after these messages. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Planning for life. Wealthway Financial Advisors. Planning for life. Wealthway Financial Advisors. Planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. All right, tonight, talking about the role of insurance in financial planning. I started this 2 shows ago, but I didn't get through all of it and thought I had enough good material that I should do part 2 tonight. So a little bit of review, the purpose of insurance in financial planning. Let's just make sure we're all up to speed on that. The basic mechanics of insurance. So really, all insurance is a financial tool that transfers financial risk from an individual who can afford to assume that risk to an insurance company that is much larger and more diversified that can afford to absorb the risk in exchange for a premium payment. Now, there's a lot of complexity that goes on behind the scenes besides just transferring financial risk from individual to insurer for a premium. There's a ton of actuarial math that goes into setting the price for that insurance premium and in drafting the insurance contracts that govern the insurance relationship and on what types of claims they will pay out for and how much they would pay off. But we're going to stick to the basics and try to keep this high level. So generally speaking, where we want to use insurance in financial planning is in 4 different categories: risk management, asset protection, income preservation, and peace of mind, which is hard to put a price on, right? And differs for each person. So risk management, asset protection, income preservation, and peace of mind. And then generally, the basic types of risks that are insured that most of us are familiar with. There's the personal risks, such as illness, disability, death. Property risks, like theft, fire, and other natural disasters. And then liability risks, legal claims, and accidents. Those are the three broad categories that most directly apply to financial planning, using insurance in the financial planning process. And at Wealthway, we have a certain philosophy around insurance that I think is a little bit contrary to most people's view on insurance protection. But then again, we work with a certain clientele that tends to have higher than average savings and investments at their disposal. But if you fit that profile, then we believe in being as lightly insured as possible. That means assuming the risks you can afford to take and then transferring the risks that you cannot. And by so doing, you enjoy lower insurance premiums. So let me just say that again, because this does apply. It doesn't just apply to Wealthway clients, I should say, but it can be applied to your own situation no matter your level of income or assets. So assume the risks you can afford to take, but transfer the risks you can't. So for what that means in practice is don't insure small risks. For most people, you don't need to insure the windshield on your car, okay? Or you don't need to carry so low of a deductible on your health insurance that it's a $20 copay to go to the doctor. Those are risks that most people who have a job and have just a semblance of an emergency fund can afford to assume. So don't transfer that risk to the insurance company and pay them for that risk. Pay them for assuming that risk because you can afford to take it. If something minor like that happens, you can dip into your emergency fund and you can pay for it yourself. But what you do want to do is transfer the risk that would be financially devastating or catastrophic. If your house burns down to the ground, how likely are you going to be able to pay cash for the rebuild without insurance, right? Most of us cannot. That is a risk you want to assume. How about the risk of being in an auto accident and getting sued for maybe $300,000, $400,000, $500,000? Is that something that you want to be liable for? That's a real possibility. Might not be probable, but it certainly is possible. And something like that could be devastating to your household. So that's the type of risk that you do want to transfer to an insurance company and that you do want to pay for through an insurance premium. And so basically what you're doing is you're shifting the insurance coverage from the low end, we call it from the small risk, up to the high end. And when you do that, your insurance premiums become much more affordable. Insurance companies love it when you insure the small risk. You pay a lot for that coverage, and they don't pay a lot in claims when they're paid out. So it doesn't typically make good economic sense for you to insure those small risks. Now, for those of you who have a good solid emergency fund, defined as anywhere between 3 to 6 months of household expenses, you may be able to take on even more smaller risks. Raise your deductible, in other words, on your auto insurance premiums or on your homeowner's insurance premiums. So instead of having a $100 deductible on your collision insurance, raise it up to $500. Or $1,000 on your vehicle. If you have enough set aside in a bank account for emergencies, you self-insure those small risks. But what you want to protect against is that catastrophic auto accident that you might be found liable for, and then have to pay out a large legal claim, then that's definitely something you want the insurance company on your side for. Same kind of goes with medical insurance. That $20 copay, that you pay out of pocket feels nice when you do that, but you're just paying more in a monthly health insurance premium than if you raised your deductible. And when you went into the doctor, maybe it cost $100 or $150. Well, again, out of cash flow, you probably should be able to handle that. But what you can't afford is that unexpected emergency trip to the emergency room that might cost $10,000, $50,000, or $100,000. So that's a risk you want to shift. All right, going to pause right here for a short news break. We're going to be right back after these messages. 627-7979. I'm certified financial planner Kevin Zibna. You're listening to Dollars and Common Sense on News Talk 790 WNIF.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zibna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, we got those. Give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, September 9th. But if you can't catch us live every second and fourth Tuesday of the month at 6 p.m., get the show as a podcast. Search for Dollars in Common Sense wherever you get your podcasts. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors. Hit that like or follow button. And once every week or two, we put up an interesting and informative financial planning post. All right, 627-7979 is the studio line. Tonight, we're talking about the role of insurance in financial planning. And I was doing a little review of the show from 2 shows ago when I started this subject. And at the time, was able to get through information on life insurance, health insurance, and I believe we got through some on disability insurance as well. So I'm not going to belabor those here tonight. If you want to find out more about those subjects, then you can, well, number one, get the podcast. It's our last podcasted show, so you can get that, or you can go to our website, wealthwayadvisors.com, and we also have recordings of the show on the website, so you can go back and listen there as well. So, I'm going to say a couple things about each of those, though. Life insurance, everyone pretty much understands how life insurance works. What they don't typically know is the differences between the types of life insurance. And generally speaking, in broad terms, life insurance comes in term life insurance, whole life insurance, and universal life insurance. So term life insurance is kind of known as pure life insurance. You get a fixed coverage for a specific period of time. It's the most affordable type of insurance. It's the most simple type of insurance. It's the easiest to understand, and it's what's kind of known as pure insurance. So, for example, you might get $1 million worth of life insurance coverage for 20 years. So if you die within that 20-year period, then the insurance pays off. If you live past the 20-year period, which we hope you do, then the insurance disappears. You paid the premiums and it never paid out. But during that time, you and your family had that peace of mind of the financial coverage. Whole life is a permanent form of coverage, or at least it lasts for your whole life, and it usually comes with a cash value accumulation feature. So it's more expensive. The premium costs a lot more on a monthly, quarterly, or annual basis to pay for whole life insurance because it is designed to go for your entire life, which means it's going to pay off at some point. And because it has a cash value accumulation feature, you're actually overpaying for the insurance, and that overpayment goes into like a sort of savings account at the insurance company. Usually pays a nominal amount of interest, and then that savings builds up over time and can be used for other purposes besides insurance. You can use it to pay premiums at some point. You can usually take loans from it. It has you have other options with whole life insurance. However, again, it comes with a much higher cost than term life. And then from our financial planning perspective at Wealthway, we feel that most of our clients don't need insurance for their whole life. If you do your financial planning properly and you continue to save and invest throughout your life, then eventually you should build up the assets and savings so that if you met an untimely demise, you would have other means to protect your family and your loved ones. Plus, while you want protections when your kids are young, at some point they grow up, move out of the house, and they're no longer your financial responsibility. So the need for whole life insurance typically goes away at some point if you do your financial planning properly. It can reintroduce itself later in life if your assets become very large, but that's sort of a separate topic and a very low probability event. And then there's universal life, which comes with flexible premiums and flexible death benefits, and also an investment component. So basically, whenever insurance, if there's any objection ever raised to a life insurance, insurance companies have designed a product to overcome that objections to get you to purchase life insurance. But it is a good and usually necessary component of a good financial plan at some point over most people's lifetime. All right. Then a little bit on health insurance, because that's a big aspect of people's everyday lives. That protects against high medical costs and ensures access to health care. It would be great if we could walk up to our doctor or the hospital and pay for their services out of pocket. And I guess while that is theoretically true, it is prohibitively expensive to do without insurance in place, even if you have a high deductible plan. That's a topic for another day. That gets a little bit political, so I'm not going to touch that one tonight. Generally speaking, the types of health insurance come from your employer. We're all familiar with that. We've kind of ingrained that in the American culture that we have to get our health insurance from our employer. No, that's not true. That has never been the case that we have to get it from our employer. There have always been independent individual and family plans that you can purchase direct from insurance companies, not through your employer. And nowadays with the ACA marketplace, the American Healthcare Act, I think, CARE Act, I forgot exactly what that acronym stands for, but the marketplace, Obamacare for short term, that still exists, and you can get insurance directly off of that, sometimes with subsidies to make it cheaper and more affordable based on your income. And then there are government forms of health insurance, Medicare, which we all get at age 65 or are eligible for at 65, Medicaid, which is a state-administered health insurance for people of lower income means, usually takes care of the lowest 20% of incomes in the U.S. And so we all have a health insurance safety net available to us through Medicaid. And then, of course, a lot of you familiar with TRICARE, which is the health insurance program for government employees. And thanks to Mike's handiwork there, I now know that ACA stands for Affordable Care Act. That's the ACA marketplace. I just couldn't pull that out of the recesses of my brain. All right, so that's a little bit of primer on health insurance. And then, as I said early at the show, a lot of the premium cost goes into what type of plan you choose, whether it's an HMO or PPO, how you choose to get care, and then the level of deductibles and copays and co-insurance that you select. The more payment that you are willing to bear as an individual, so again, that low end of the risk, the cheaper is the health insurance premium. So for people who have a good emergency fund and stable income, they can typically afford to pay more out of pocket when they go and get medical services. But what you do want to make sure you do is shift up the coverage. So if you're going to assume more risk on the low end, you want to get better coverage on the high end to protect against a catastrophic loss. And by doing that, you enjoy lower premiums than when the insurance company is basically subsidizing your routine medical visits, and you only pay that $20 copay. All right, so I wanted to move into a little bit more on auto insurance because I don't think I touched on that the first show. We all have to deal with auto insurance if we are drivers. Covers vehicle damage, liability, and medical expenses from accidents. And it comes in a variety of types of coverage: liability, collision, comprehensive, and uninsured or underinsured motorists. And in Virginia, we are all required to have, I think the number is $100,000 of uninsured motorist coverage. So for those people who I think you have to have the insurance, right, to legally register a car in Virginia. But if you just don't and you drive around illegally, then you are uninsured. Then the people who do pay for this coverage at least have that if they're hit by somebody with no insurance coverage. But liability, collision, comprehensive are the ones that are most important. Liability is required by law. That covers damages that you cause to others. Collision covers your car in an accident. And comprehensive covers damage to your car like theft, vandalism, weather damage, tree falling on your car, that type of thing. And then some of the factors that go into determining the cost of your auto insurance premium, well, your driving history is one. You got a good driving history, you're a safe driver, then you are less likely to be in an accident. Your premiums are lower than somebody who gets a lot of speeding tickets or has a lot of citations on their driving record. Also, the vehicle type that you drive, lesser expensive cars are cheaper to insure because they are cheaper to repair or replace. More expensive vehicles cost more insurance premium. Also, the location within the state where you are determines to a certain extent the premium. If you are in a more congested metropolitan area like we are here in Hampton Roads, our insurance premiums are a little bit higher than people in the western edges of the state, out near Stanton, say, or what is that town on the border by Tennessee? I can't remember. Anyway, Franklin? No, that's another. Anyway, if you're out in the Shenandoah Valley and small towns there, they have lower insurance premium. And then another thing that impacts your insurance premium for auto insurance that most people don't realize is your credit score. What does my credit score have to do with my driving record and my insurance premiums? Well, the insurance actuaries, those are the math nerds that crunch the numbers that determine how much risk the insurance company is assuming and therefore how much to charge you for the premium. The insurance actuaries have determined that there is a correlation between your credit score and your likelihood of getting into an accident. So what does that mean? It means that the lower your credit score, and you have a low credit score if you don't pay your bills on time, or don't pay your bills at all, if you have judgments, if you have liens, if you have a bankruptcy, if you don't pay your financial obligations in a timely manner, then they have determined that you are statistically high. You are at a statistically higher incident of being in an accident because you are probably a less responsible driver. Less responsible with your finances, probably less responsible as a driver, more likely to be in an accident, more likely the insurance company would pay the claim. Therefore, they are going to charge you a higher premium. And of course, the reverse is true. The better your credit score, the lower the insurance premium you can enjoy. All right, got to take our last break. We'll be right back after this message. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, check us out online at wealthwayadvisors.com. All right, tonight, talking about the role of insurance in financial planning. And I want to move on to property insurance, yet another big one that everyone is familiar with. If you, you don't just have to be a homeowner, but basically property insurance protects your home and belongings from damage, theft, or liability. So most of us know it as homeowners insurance, which covers the structure, the contents, and some of the liability of being a homeowner. So if somebody slips down your stairs and breaks an ankle, you may be liable for that and that person's medical bills and maybe their pain and suffering as well. So homeowners insurance helps protect against that type of claim or loss. But there's also renter's insurance, right? For people who don't own a home, you still got stuff. You still got a couch and TVs and a phone and a bike and other sort of property. So it protects renter's property and liability. So if a renter causes damage to the apartment complex inadvertently, then the insurance company will usually pay out for that. And then specialty coverage like flood, earthquakes, hurricane are usually separate policies or addendums to the basic insurance policy. And the reason they have to be separate is because there's a higher probability that those events will happen in certain areas of the country, right? Around here, it's hurricanes. On the West Coast, it's probably earthquakes. But there's a high probability that those pay out, and they also come with a higher cost when there is a weather event like that to the insurance company. So it's usually an add-on to the insurance company. It's not, add-on to your basic insurance policy, not part of that package. And then when it comes to homeowners insurance, one of the things you want to make sure that you have two choices on how you cover the rebuild on your property. Let's just say it was a total loss due to fire. You can have insurance coverage for replacement cost or actual cash value. And a lot of people don't know the difference. So actual cash value of your property is what it kind of cost when you bought it, what you paid for it, which, if you bought your home 10 years ago, well, it's probably worth a lot more than what you paid for it. But if it's a total loss, you're only going to get what you paid for it if you insure it under the actual cash value level. The replacement cost is what most people really want. Is if I got to rebuild that house today with using today's building costs and today's materials, I want to be made whole. I get it insured at replacement costs. All right, and the last one I want to talk about tonight, casualty insurance. That's also known as liability insurance, a broad category covering liability for accidents, injuries, and negligence. So umbrella insurance, business liability, and workman's comp insurance are various types of casualty insurance. The main thing to know about that is we love umbrella insurance coverage. It's extra liability coverage that sits on top of your auto and homeowners coverage. It's relatively inexpensive, usually just a few $100s a year for $1 million worth of additional coverage. It's very easy to get in place. Usually call your existing insurance company, tell them you want umbrella coverage, or a personal liability umbrella plan can also be called that. But umbrella coverage sits on top of your other insurances and acts as extra liability protection. I won't get into it tonight, but we love this type of coverage in lieu of a trust work and trust setup. If the trust is sort of for liability protection purposes, I think it can be accomplished a lot simpler, easier, and cheaper with umbrella insurance. So you have all these different types of insurances, obviously, and the cost of all the insurances, all the premiums you pay, is probably the second or third highest output after taxes and mortgage on your house. So it's really important that you keep tabs on it, that you shop it around from time to time. Know that what the right purpose of the insurance is, so you get the right type of coverage, the right levels of coverage. All of these things, and of course, because there's different kinds of insurance, a lot of people tend to have associations with different types of insurance salespeople. Where you can get an insurance broker to tie it all together, package it for you, usually gets you the best all-around coverage for the lowest rates. You don't usually get that when you just bring everything to the large major carriers that we all see their commercials on national TV. That's all the time we have for tonight. I got to scoot out of here. We'll be back in 2 weeks on Tuesday, September 9th. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense.
The program was sponsored and paid for by Wealthway Financial Advisors. We are solely responsible for its content.